Chinese companies could sell up to $1 trillion in dollar-denominated assets as the U.S. is expected to cut interest rates. This move could strengthen the Chinese yuan by as much as 10%. Nigel Green, CEO of deVere Group, a leading financial advisory and asset management firm, has issued a warning about this potential shift, which could have profound implications for global financial stability. According to Green, recent trends indicate that Chinese companies, having accumulated over $2 trillion in offshore investments, primarily in U.S. dollar assets, are poised to make a major adjustment. These investments were initially driven by the higher yields available abroad compared to domestic yuan-denominated assets. However, with the Federal Reserve likely to cut interest rates next month, the appeal of holding dollar-denominated assets may diminish, prompting Chinese firms to consider repatriating their capital. As U.S. borrowing costs are expected to fall, the attractiveness of holding assets in dollars could decline. Traditionally, Chinese corporations have sought higher returns in U.S. financial markets, but they may now shift their investments back to China. This potential repatriation is projected to range from $400 billion to as much as $1 trillion in dollars. Such a substantial capital inflow could have a significant impact on the dollar's value, potentially altering the global financial landscape and the relationship between the Chinese yuan and the U.S. dollar. This shift is largely driven by the narrowing interest rate differential between U.S. and Chinese markets. Before we dive further, please consider liking the video and sharing your thoughts in the comment section below. Your feedback is invaluable for us and the wider audience worldwide. Nigel Green further noted, in recent years, Chinese companies have diversified their portfolios across various U.S. assets, including treasuries, corporate bonds, and real estate. However, with the Federal Reserve signaling a shift toward lower interest rates, the appeal of these investments is fading. As a result, Chinese firms may start seeing more value in domestic investments, leading to a significant movement of funds back into the yuan. The potential impact of this move extends far beyond the yuan and the dollar. A substantial appreciation of the yuan could reshape global trade dynamics, particularly in emerging markets that compete with China in export sectors. If the yuan strengthens considerably, other Asian economies with weaker currencies could benefit, potentially altering regional trade balances and economic relationships, Green emphasized. For global investors, this shifting landscape calls for immediate attention. Changes in currency values could lead to major shifts in investment returns, risks, and opportunities. Investors should carefully monitor U.S. monetary policy and Chinese economic developments to understand the potential effects on their portfolios. Adjusting investment strategies to account for a stronger yuan and a weaker dollar may be essential for managing risks and capitalizing on new opportunities, Green concluded. Stephen Jen, CEO of Horizon SLJ Capital and known for his dollar smile theory, predicts that the Federal Reserve may cut interest rates more aggressively than markets expect if U.S. prices continue to decline. He also believes that an overvalued U.S. dollar, along with America's twin deficits, strengthens the case for a dollar downturn. As a result, the Chinese yuan could rise significantly against the dollar, especially if the People's Bank of China avoids intervening to absorb excess dollar liquidity. Jen also highlighted the potential impact of Chinese companies repatriating their U.S. dollar-denominated assets, which could lead to notable shifts in currency markets, affecting investment returns, risks, and opportunities. Investors are being urged to prepare for major changes in the currency landscape as this scenario unfolds. Currency is now the biggest risk that isn't properly priced in across markets, and the yuan may play an outsized role, Jen stated. He likened the possible impact to an avalanche, suggesting that the yuan could appreciate by 5% to 10%, which would be modest and acceptable for China. The case for yuan gains appears even stronger after Federal Reserve Chair Jerome Powell's comments at the Jackson Hole Symposium, indicating that the U.S. may soon begin cutting interest rates. However, Jen noted that a major appreciation in the yuan might not happen immediately after the first Fed rate cut. It could occur when the dollar starts to decline more rapidly, particularly in a soft landing scenario where U.S. inflation eases without triggering a recession. Jen also pointed out that China is focused on reducing its exposure to the US dollar. Chinese policymakers have been closely watching how the United States has used the dollar as a tool of economic warfare, particularly in the case of Russia. The U.S. froze Russia's dollar-denominated assets and even considered redirecting them to Ukraine. This has raised alarms in China, which now recognizes that the U.S. could potentially wield the dollar against them in a future conflict. As a result, China is seeking to strengthen its currency, the yuan, to prepare for a possible economic standoff with the U.S. China is accelerating its de-dollarization efforts, especially as trade relations with the U.S. show little sign of improvement. Recently, the Biden administration imposed tariffs on a range of advanced Chinese products, targeting industries like electric vehicles and batteries. In response, China is not only reducing its dollar reserves, but is also diversifying its financial assets globally. If China sells off $1 trillion worth of dollar-denominated assets as the U.S. lowers interest rates, it could boost the yuan's value by up to 10%, while dealing a significant blow to the dollar's global standing. China is also increasingly investing in gold as part of its effort to reduce reliance on the dollar. Gold now makes up 4.9% of China's reserves, its highest level since 2015, a trend that many other central banks are following as they rapidly purchase bullion. This shift was largely triggered by fears of U.S. sanctions, especially after witnessing how the West applied dollar restrictions on Russia in 2022. The key question is, how big of a problem is this for the U.S.? If China were to dump its dollar-denominated assets, it would create a significant gap in the U.S. Treasury market, as the federal government continues to run large deficits month after month. Foreign investors currently hold about 1/3 of U.S. Treasuries, and if China were to sell off $1 trillion in these assets, it could create serious challenges for both the U.S. economy and the dollar's value. Don't forget to subscribe to our channel for more updates on important international issues. Thank you for watching,